Ladies and gentlemen, good day and welcome to Latent View Analytics Q3 FY22 earnings call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Diwakar Pingle from Christensen IR. Thank you, and over to you, sir.
Thank you, Aman. Good evening to all the participants on this call. Before we proceed on this call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result performance or achievement to differ significantly from what is expressed or implied by such forward-looking statements. It gives me a great pleasure to invite all of you to the Q3 FY22 earnings call of Latent View Analytics Limited. This is the first quarterly call, as you know, that the company is doing after the public listing. The results of the investor presentation have been mailed to you and is also available on the website at www.latentviewanalytics.com. In case anyone doesn't have a copy of the press release or the presentation, please do write to us. We'll be happy to send the same to you. To take us through the results today and answer your questions, it gives me great pleasure to introduce my classmate from my college and the CEO of the company, Rajan Sethuraman. And we have another Rajan in Rajan Venkatesan, who's CFO. For purpose of this call, questions to the CEO can be addressed to Rajan and to the CFO as Raj, so that there's no confusion while we're transcribing. We'll be starting the call with a brief overview of the company given by Rajan, which will then followed by financials given by Raj. With that said, I'm going to give it away to Rajan. Over to you, Rajan.
Hey, thanks, Diwakar, and welcome and thank you all for joining this call. This is our first quarterly earnings update, as Diwakar mentioned, after we went public, and we are really happy and excited to have you on the call today. I hope all of you and your families are safe and healthy right in the current challenging times. Since this is the first time that we are doing an earnings update post-listing, we wanted to take a few minutes to give you a brief overview of the company, including who we are and what we do, for the benefit of those of you who are listening to us for the first time. I understand that this might be a bit of a revision for others who have heard us before. So I would just request you to bear with us as we take you through some initial update. So first off, we were founded in 2006, so it's been 15 years now. We are a pure play data and analytics company. In that we do only data analytics work. We don't do the usual services that you find under ITS umbrella, such as ERP implementations, or package selection, or custom development, or application maintenance. However, within the data analytics spectrum, we do pretty much everything that comes under that. In many of our engagements, we typically start off with a consulting or a diagnostic work, wherein we sit down with our stakeholders and help identify what are the data analytics initiatives they can undertake in order to realize their business goals and objectives. About 10-15% of our work is actually in the nature of the consulting diagnostic work, and we see that increasing day by day as more and more organizations are ramping up on the digital transformation initiatives. The other big chunk of the work that we do is what we call data engineering and data services. Herein we actually help clients build the data foundations and platforms necessary to undertake the analytics. Most organizations today have data in multiple silos scattered across their organization, and they also need to use both structured and unstructured data from the outside, such as social media, or it could be IoT sensors and devices. We help architect, design, and implement platforms that can pull data from multiple silos, which then allow you to do any of the analytics that you want to do to answer the big questions that are staring in front of them. The mainstay and the bulk of the work we do is what we call business insights and analytics, and that's about 60% of the work. Here is where we take a look at look back and look ahead analytics. Look back is typically of a diagnostic and descriptive nature, answering questions around what happened and why did it happen. And the look ahead is around predictive and prescriptive analytics, which is where we use typically artificial intelligence or machine learning or other new algorithms that are relevant to the modeling task at hand. So about 60% of the work that we do is the business insights and analytics services. We mostly work with Fortune 500 companies and mostly with the business units and functional heads in these organizations. So typically the chief marketing officer, chief finance officer, CHRO, or chief supply chain officer and their teams. And we help them solve fuzzy, ill-defined problems. In many instances, these problems arise from their business goals and objectives, and it could be fairly high level, questions such as how do I improve my market share, how do I reduce my customer churn, how do I optimize my supply chain and reduce my inventory costs, for example. In terms of sharing a few splits, from a geography standpoint, most of our revenue today comes from the US. We do have a fledgling business in Europe with subsidiaries out of the UK, Germany, and Netherlands. And it's our intention to ramp up the penetration into the European markets in the coming quarters. We are also looking at expanding our presence in the Asia Pacific region as well. We have a Singapore subsidiary, and we intend to capitalize on that in the coming quarters. From a value chain standpoint, we mostly work at the front end of the value chain, addressing problems in customer and marketing analytics. In customer analytics, questions around segmentation, micro-segmentation, cross-sell, upsell opportunities, identifying customer lifetime value, loyalty, and personalization related questions. And then marketing around marketing return on investment, media mix modeling, campaign analytics, going dark analysis, for example. The rest of the work from a value chain standpoint falls between supply chain, finance, fraud, and counterfeit analytics, and also increasingly people and HR analytics. These are areas that are growing rapidly, and we are investing in these areas as well. From an industry standpoint, a lot of the work that we do is with technology and digital native companies, could be fintech, e-commerce companies as well. About 2/3 of our revenue comes from these industries, and the rest of the revenue is split across industries including retail, consumer products and hospitality, industrial, which is a mix of automotive, oil and gas, logistics, and then also banking and financial services. I just wanted to also highlight the differentiation that we bring to the table in comparison to some of the other players in the space. We sometimes compete with strategy consulting firms, including a McKinsey or a BCG. We do see other IT service providers and their analytics practices and systems integration firms in the fray. Sometimes we also see product companies in the fray. Some of the things that set us apart is, one, our technology and digital native focus. This is a very, very strong expertise that we bring to the table, having built most of our business working with these companies over the last 15 years. The second is the unique combination of business, math, and technology skills that we bring to the table to address the fuzzy, ill-defined problems that I talked about. A lot of the work that we do is around helping decompose these ill-defined problems into hypotheses and issue trees and problem statements, which can then be addressed using the power of data analytics. So the people that we bring to the table, right, in terms of people who are part of the engagement, the delivery teams, also bring a mix of this business, math, and technology skills. And that is a very strong differentiation in comparison to other organizations which come from their own vantage points. We also have a strong suite of solutions, assets, and accelerators that we have built over the last 15 years. And these help us kickstart engagements and get non-linearity in terms of the effort that we spend, as well as the revenue profile that we can generate. Some of these solutions are very specific at the intersection of an industry and the value chain. Like, for example, the solution that we built for the beauty and cosmetics industry, which has now been extended to many other CPG market segments, primarily focused on identifying trends and spotting them before they become big trends, so that the company can come up with a product or an innovation that can capitalize on that trend. So this is a product called Smart Insights. You have more information about the different solutions that we have built available on our website. Another big differentiation is the consulting-led approach. I mentioned earlier on that many of our engagements start with a consulting diagnostic exercise. In many ways, the work we do is more akin to business management consulting as opposed to IT services. We lead with the value propositions that we have been building. One of the recent value propositions that we have put out in the market is around subscription analytics, and you might have seen some media around that. This is addressing the transition that many companies are making in terms of taking their products and services into a subscription model, an as-a-service model, and we are playing out very, very strongly right in this space. So that's just a bit of background about the company, who we are, and what we do. I will now move on to the quarter 3 update. We had a very strong quarter, and we actually ended the quarter on a high note in terms of the growth that we have seen in our revenue, as well as in terms of the margin and the EBITDA profile. This has been true also of the year to date, where we have actually performed really well in comparison to the last year. The good thing to note also is that a lot of the work that we have won in this year and in this quarter, over 15 new clients in this year so far, and 6 coming in this quarter itself. They are all on the back of managed service engagements and contracts that we have signed with them, as opposed to fixed fee, fixed scope projects, right, that we were doing earlier. So a lot more traction on the managed services model. We continue to see a lot of traction in terms of getting work done offshore, and this has helped us retain and improve the on-site offshore ratio over the last few quarters. A few things that were highlights for us this quarter are, one, the launch of the subscription analytics growth accelerator that I talked about. This is finding quite a bit of traction in the market. We are also investing in building out our supply chain practice and our advanced analytics practice. We have hired people recently to head up these practices, and they are further building out the team as we speak. A few other external recognitions that we had, we became a Snowflake Premium Services partner. This is just one tier below their highest tier. We are already collaborating with them from a go-to-market perspective, and we have won engagements, as well as we are in discussions with many clients in terms of helping implement Snowflake within their data ecosystems. We also won the top firm to work for in artificial intelligence analytics, put out by the 3AI Association, and we were recognized by Everest as a major contender for analytics work. And we recently won the Best Blended Learning Strategy Award by Transformance Forums. On the people side, a few updates. We have been adding people to support the growth that we have been experiencing this quarter. Of particular note is we have hired about a dozen people, close to a dozen people at the senior manager and above levels to spearhead many of the initiatives that we are pursuing. We continue to see very strong demand for our service across the consulting, data engineering, analytics, and solutions spectrum. In terms of addressing the demand supply gap and the talent shortage that everybody is talking about, we did 2 wage hikes this year, one in April and one again in October, to ensure that we are competitive and that we are benchmarking our compensation policies with the market. We also issued the employee stock options to almost 30% of our people prior to the IPO. So all of these people are now proud owners, and they are vested in the company. And at this point in time, a lot of our hiring is focused on the campus, because we do have a critical mass of people at the experience level, right, who are able to induct these newcomers and then make them productive in a very short span of time. So overall, well positioned both from a demand and a supply perspective in terms of the opportunities that lay ahead of us. With us, I'm going to turn it over to Raj to take you through some of the numbers. Raj, over to you.
Thank you, Rajan. Good evening to everyone on the call today. I would like to first of all thank you for joining this call. This is our first earnings call since the time we went public. Looking back in time, we were actually overwhelmed by the response to our IPO, where we were oversubscribed the record 338 times. We welcome all our new shareholders, and thank you for trusting your capital with us. Coming to the financial performance for this particular quarter, we clocked a quarterly revenue of in excess of 1 billion rupees or 100 crores for the first time in the company's history. Our operating revenue for this quarter was at 1078 million, witnessing a growth of about 13.7% on a quarter-on-quarter basis and 37.7% on a year-on-year basis. EBITDA for the period for this quarter, the third quarter, stood at 322 million, which was at a growth of 21.8% on a quarter-on-quarter basis and 19.1% on a year-on-year basis. The EBITDA margins by themselves for the quarter were at about 29.9%. Coming to our PAT numbers, the PAT again witnessed a growth of about 130% quarter on quarter and about 122.4% year on year. And the PAT for the current quarter was at 499 million with a margin of 44.2%. I will come back to the PAT itself later in the call, but I would like to first talk about the growth in revenues that we witnessed in this quarter. So the growth in revenues was driven by strong demand across our existing portfolio of clients as well as addition of new logos during this quarter. Specifically, in terms of the verticals that drove this growth, technology, which is already one of our strongest verticals, contributed to about 58% of this overall growth. And CPG, which is consumer and retail, contributed about 29% of the growth witnessed in this particular quarter. Also, historically, Q3 has been our strongest quarter, as most of our clients are based in the United States. Close to about 95% of our revenues comes from that geography, and most of them follow a Jan to December calendar cycle for their fiscal purposes. Typically, Q4 is the October to December quarter is when they end up consuming all their budgets, and therefore Q3 is always a fairly strong quarter for us. Coming to the cost side, in the current quarter, the employee cost increased by about 15.2%, primarily driven by the hiring and the investments that we continue to do. And also, Rajan spoke about the increments that were given out in Q3. We gave out increments ranging between 16 to 17% in India and about 4% in the US. Additionally, Q3 also had the impact of the ESOP that were given to a fairly large base of employees in Q3, and that contributed close to about 1.3 crores of the additional expense in Q3. The other expenses have fairly, or the SG&A, if you look at it, have remained fairly flat across quarters. If you take Q1, Q2, and Q3, with the exception of Q2, where there was a marginal increase in other expenses, and that again can be attributed to certain IPO-related, for which we had to take a P&L. We had to charge it through the P&L. The total IPO-related expenses that we charged through the P&L amounted to about 10 million in Q2 and about 6 million in Q3. During this quarter, which is the third quarter, we also recorded an exceptional gain of 226 million on account of receipt of waiver from the government of the United States in respect of the Paycheck Protection Program. This was a grant that was given in April of 2020. During the current year, the company had applied for a waiver of this grant, and we received that particular waiver in the Q3, and we've recorded this particular item as an exceptional item on our P&L. For the 9 months, if you look at it, our operating revenue stood at about 2904 million, or roughly about 290 crores, reflecting a growth of 28.2% on a year-on-year basis. The EBITDA for the 9 month period came at 860 million, recording a growth of about 12.7% on a year-on-year basis. EBITDA margins for the 9 months again was almost in line with what we clocked for the quarter. They came in at about 29.6%. The PAT before exceptional item was at 939 million with a margin of about 31%. In terms of the geography mix, US, like I mentioned, is the strongest geography, contributing about 95% of our overall revenues. Europe contributed about 3%, and the rest of the world came in at about 2%. In terms of sectors, revenue from technology was close to about 67%, followed by 15% in CPG and about 18% coming from the other verticals. To summarize our performance, and what we would like to re-emphasize is that we continue to build on the excellent momentum in the market. We continue to add capabilities, sales force, as well as domain expertise. We will continue to invest for growth in the coming quarters and also look at inorganic opportunities. Our intent is to continue to deliver healthy growth in the coming quarters as well. With that, I'll hand it back to Diwakar, and we can open up for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Also, participants are requested to limit a question to 2 per participant. If time permits, you may join the queue for any follow-up. Anyone who wishes to ask a question may please press star and 1. First question is from the line of Venkat from 3 Sigma Financials. Please go ahead.
Thanks for the opportunity and excellent set of numbers, sir. Yeah, can you just tell me on-site to offshore mix? You just mentioned about a good, healthy on-site offshore mix. If you can quantify, that would be great.
Yeah, sure. Hey, we are currently trending somewhere in the 1:5.5, 6 kind of a range. It's kind of steadily improved over the last 18 months. Obviously, some of it is driven by the increased acceptance of clients to move more work offshore, given that everything is already happening remote. But in addition to that, we have also enabled some of these models through better collaboration mechanism and also implementing what we call a remote on-site model, wherein people sitting here offshore can perform traditional on-site roles because of the collaboration and other mechanisms that have been made available. So I would say that over the 24 months, it's been trending from around a 1:3, 3.5 range to a 1:5.5, 6 kind of a range at this time.
Fantastic. Sir, what is the average revenue per client? Approximately.
So, Raj, do you want to take that?
So just to give you a sense, I mean, while average revenue, because we don't have a very homogeneous mix of clients to answer your question specifically, but if you look at the earnings presentation that we put out, we've also highlighted what is the typical revenue that we have from our client side in terms of how much our top 5 clients contribute, how much the next 10% contribute. So if you look at our top 5 clients, they roughly contribute about 61% of our overall revenues. The top 10 clients contribute about 75%, and our top 20 clients contribute about 90% of our overall revenues.
Sir, revenue per employee is the highest in Indian IT industry. Hope this will continue moving forward. Any light on that? Any comments on that?
So our revenue per employee, Rajan did speak about the fact that we tend to play at the higher end of the value chain. Typically, you can almost we differentiate ourselves from the typical IT services providers in the sense that we tend to solve fuzzy business problems, and therefore the combination of people that we put on any project, which is typically a combination of engineers, people with MBA backgrounds, and also people from economics and math backgrounds. So this sort of a skill mix is also in play, and therefore we are able to our revenue per mix in that sense has always been higher than the traditional IT players, and we hope to continue the same level. We hope to continue at the same levels even in the future.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. Our next question is from the line of Dev from Invest Yadnya. Please go ahead.
Thank you for letting me ask a question. Hello, am I audible?
Yeah, we can hear you, Dev. Go ahead.
Yeah. So can you tell me the nature of the deals? Means what is the deal size and all, if you can give some background?
Yeah, I mean, typically the deals we have been able to migrate more and more to what we call a managed service kind of a deal, where visibility not just for a particular initiative, but a suite of initiatives that have been identified and set up as a book of work on the back of the consulting and the diagnostic engagement that we do upfront. So the team sizes in these managed service constructs can range anywhere from 5 to even 100 people, right? For example, with the biggest account. And that team then becomes either the exclusive or the extended analytics capability of the client organization, and then they become responsible for executing all of those initiatives that have been identified. And for each of those initiatives, we identify the team composition, size, and everything based on what are the objectives, what are the outcomes that are expected from the initiative. And typically, we price all of these to the client as an entire team. So that's how the model has been. So it ranges therefore, right, in terms of the size of the engagement. Of late, we are seeing an uptick in terms of the size of the engagement because of the managed services construct. It means that typical starting engagements could range anywhere from $250,000-$300,000 to upwards of $1 million as well, right, depending on the initial problem definition and the suite of initiatives that are set up. So it's a spectrum, but it's been trending upwards because more and more clients are looking at undertaking the more significant complex initiatives, right, through data analytics.
Okay. And sir, so how is revenue recognized? So is it annuity based or how do you recognize the revenue?
So I'll take that question. Our revenue recognition is fairly straightforward. We typically classify the nature of the work that we do into two broad buckets, one of which is managed services, the other one being time and material. So if you look at the broad split of the revenues itself, managed services contributes anywhere between 70 to 80% of our overall revenue bucket, with T&M contributing to about 20 to 30%, depending on a particular quarter. For managed services, the way we bill our clients is on a fixed price per month, and the way we arrive at that price is the formula for that pricing typically depends on, one, the complexity of the business problem that we solve, two, the skills or the skill mix that is involved in delivering that particular project, and three, also the business outcome or the value that we deliver to the client, right? And therefore, all of these inputs go into determining the pricing for a particular contract, and using this, we typically arrive at a pricing to be billed to the client on a per month basis. So there, the revenue recognition is fairly straightforward. As you bill the client, you recognize the revenue on the billing basis. Time and material, of course, there are specific projects where for instance, we as opposed to the managed services construct, we bill our clients on the basis of the number of people or based on the effort that is involved in that particular project, and there again, revenue recognition is fairly simple. So does that answer your question?
Yeah, sure. Can I ask you one more question?
Please go ahead.
Yeah. So how sustainable are the margins? Margins are very high as compared to others in the profile. So can you tell me what will be the sustainable margin range for your company?
See, if you look at our margin profile historically, and I'm talking about pre-pandemic levels, we've always operated in the range 25 to 28%. During the pandemic, of course, we had some one-time benefits of lower travel, lower marketing spends that did not materialize. If you look at our margin profile in the current year, you will see that our margin profile is slightly lower compared to FY21, and the reason for that is we've started making substantial investments. I spoke about the fact that we're adding capabilities, we're adding people on the front line, and we're also bringing in domain experts. So we will continue to make those investments going forward as well. Our intent is to deliver healthy margins even going forward, but at this point in time, we will not be able to give you an exact range or a guidance, but it will be our endeavor to continue a healthy margin profile even going forward.
Okay. Thank you. Thank you for that's it.
Thank you. Our next question is from Ranjit Gopal from HSBC Asset Management. Please go ahead.
Yeah, thanks for the opportunity and congrats on an excellent quarter. I had two questions. First one on the growth side. So, and also the fact that you mentioned that the new clients have come on the managed services kind of a pricing. So, how do you basically look at it in the context of a medium-term kind of a revenue profile for our company? So, what does managed services be different from a fixed pricing model or a project-based model? So, will it bring in more non-linearity in the revenue profile for us going forward, because clients can actually increase or also decrease the scope of work on a going basis? So can you help us understand in terms of what exactly will be the drivers of a kind of revenue profile within the managed services part?
Yeah, sure. So the preferred model is managed services because in the managed services construct, we have more flexibility in terms of staffing, ramping up, buffer resources, making sure that we are also doing exploratory work, right? All of that stuff. Whereas in a fixed fee, fixed scope, it's a fairly well-defined, specified construct, and therefore the freedom of the degrees of freedom available will be lower. But having said that, we are okay to undertake a certain volume of fixed fee engagements, fixed scope engagements, because in instances where we are interacting with the stakeholders for the first time or a new prospect, they might want to understand who we are and what we are capable of using a well-defined scoped out engagement as opposed to getting into a managed services construct. So typically what we see is that the managed services construct is something that we're able to kick off even on the first engagement itself in instances where there is a very strong referral or there is a connection that we already have or the relationship. And also on another dimension where it is very similar to work that we have undertaken in the past so that now we can bring in our suite of solutions, our frameworks and approach and methodology. Whereas the fixed fee engagements tend to be a little bit more exploratory, maybe off the earlier tracks that we have undertaken. So that's just the context in terms of how fixed fee and managed services engagements play out. More than non-linearity of revenue, I would say that managed services is really about a certain amount of revenue certainty, longer duration contract, flexibility and fungibility in managing the pyramid and therefore the margin profile, and also taking ownership and getting more involved in the strategic process of the client. Because when in a managed services construct, we typically get a seat at the table when they are discussing their business goals, objectives, and how they can dovetail their data analytics initiatives with them. So therefore, there is more earlier in the value chain involvement that happens from our end, and that is something that provides for greater stability and certainty for the revenue. Both in managed services and in fixed fee, we are able to bring in some of our solutions and accelerators and create some non-linearity from a revenue profile.
Sure, that's very clear. Thanks a lot for the detailed answer. Just a sub part to the question. I mean, would you be disclosing what is the proportion of managed services or fixed fee within our total revenues, or you're not disclosing that?
No, we are not putting it out as a specific point on the press release or the investor presentation, but I can say that broadly today about 70% plus in that range, right, is in the nature of managed services. So it's about 30%, which is really fixed fee engagement, and those fixed fee engagements will also include some pilots and prototyping, right, that we might be doing for some of the client accounts. This percentage has increased significantly. We used to be at the 35-40% level, but over the last couple of years, we have seen a significant shift, so much so that now about 70-75% of the work is in the nature of managed services.
Sure. So, which will mean that incrementally our managed services piece will move, will be a larger part of the revenue profile because we are adding more clients on that bucket than ever before.
Correct. Typically, engagements where we have reached a certain amount of steady state, right? Meaning, if you've been working with a client for more than a year, typically it has already moved into a managed services kind of a construct. And in general, new business that we get every year tends to be around 15% mark. So they tend to be sometimes fixed fee engagements, and then there'll be a few accounts that we have, right, that are still operating in the fixed fee model. We expect that the percentage will be thereabouts. I mean, I'm not expecting that we will get to a 90% managed services kind of a model. Given the nature of data analytics and the inherent experimentation that is involved in this, we believe that about a 25% in the fixed fee, fixed scope model is appropriate for this line of work.
Sure, understood. That's very clear. The second question is on the seasonality that Raj talked about, with large part of our revenue bump coming in the third quarter. So just wanted to get a little bit more color on this. So would it mean that there would be a bit of a moderation in the sequential revenue momentum going into fourth quarter? Typically, I'm talking about in terms of seasonality. I'm not asking for any guidance for next quarter. So, and what has been the kind of typical revenue contribution which is coming in from the fourth quarter over the past 4 or 5 years. So how has that actually been played out? I understand that our mix has changed. It continues to evolve. So to that extent, it may not be like-to-like comparison, but just to get a sense, what's the kind of proportion of revenues that we get in the third quarter, that is the October to December quarter.
Yeah, no, you're right. I'm going to request Raj to give you the numbers, but you're right. I mean, the mix is changing. Plus, as we said earlier, the clients are also accelerating, and then they have greater confidence in undertaking slightly longer-term initiatives, whether in the managed services construct or in the fixed fee kind of a construct. Traditionally, Q3 was big because our Q3 tends to be the last quarter for many of our clients, and therefore they are intent on spending the budgets and the money that is available. But we are seeing some shift happening there as well. So Raj, if you want to provide any color on that.
Yeah, absolutely. So Q3, like I mentioned before, is typically our strongest quarter. Having said that, it is not like we see a dip or moderation in Q4. Typically, Q3 sort of sets the momentum for us for the next year, and clients sort of reset their budgets for next year. Clearly from Q2 and Q3 onwards is when we start seeing some of that momentum coming back. To give you some sense of what the historical split is, Q3 it's not significantly higher, but it contributes about anywhere between 28 to 30% of our revenues for the full year.
Thank you. Our next question is from M. Puranik from Enam Securities. Please go ahead.
Hi, congratulations for building a great business and a fantastic quarter to begin with. I think you have a great business model and huge opportunity. There isn't any element of a digital business which includes cloud migration, customer experience, cybersecurity, and analytics, which has the longest visibility in terms of business like the analytics, because the analytics is something which will be there and there forever and keep growing, because there is so much of data. You have to keep looking at building insights on data. So you are on a great track. But my question is on the scale and scalability of this business. You are about 850 to 1,000 people today. So how do you scale your business from the current size to say, hello?
Yeah, please go ahead.
From the current size to say about 5,000 or 10,000, because those economics are very different. Because you may have the challenges in terms of getting the crucial skills and training them and retaining them. But how will you do that? Because you have rightly gone into the managed services project. That is the most scalable architecture of the services business, where you can manage several large projects. And then together with your expertise, when you distill your expertise into various digital and business components, so then you can really make it profitable and revenue scalable also. So can you help me understand your scale economy?
Yeah, sure. Thanks for the question, Puranik. So, I'll just briefly touch on the demand perspective. I think you already said it. The space is, the opportunity is immense. I also mentioned that most organizations are only scratching the surface. It's estimated, the data analytics space is estimated at about $170 billion now. It is expected to double, right, over the next 4-year time frame, right, with a CAGR of about 20% or so. So the demand potential is immense. And even at that scale, I think we will still be scratching the surface, because at the heart of a lot of the work that we do, we really trying to understand behavior, right? Whether it is human behavior, correct, process behavior, or machine behavior.
Behavior and trend.
Correct, right. From a supply point in terms of how we can scale the business, you are right. I think the people talent will become a very, very important component. At this point in time, when we compare ourselves with IT services companies or other large recruiters, we are only going and hiring a fraction of the people. Typically we go into any campus, we are looking for the best 10, 20 people, right, that we can find there. VIT, for example, right, which is a campus that we hire, they graduate, I don't know, maybe 2,000 students or more, right? No, VIT is even larger. I mean, it's 20,000 students, right? Shastra,
Right,
2,000 students, right? We are looking for 20 people, 30 people, and we are able to attractive employee value proposition. I think that ability to attract high caliber people will hold in good stand even when we are, say, 10 times the current size because of the number of people that we are looking for. But having said that, I think the more important aspects are the following. One is that our go-to-market strategy going forward is going to be increasingly based on the specific value propositions that we define. I talked about the subscription analytics. There is digital marketing. There is B2B sales operations. The supply chain, connected visibility. That's a big initiative for us. So there are very specific value props that we have identified, and those value props will be the plank on which we will go to the market. When you define a value prop, it becomes a solid offering supported by a lot of thought leadership, knowledge capital, assets accelerator, right, that we can bring to the table. So I think that will be a very important thing that will provide the non-linearity that we need in the revenue profile. The second aspect of that is the general drive towards automation. And you are seeing this in IT services. We are no exception, and we are actually in the business of automating decision making. So increasingly, even the work that we do as a team, we will be looking for ways by which we can automate it. We can make it more reliable. We can embed it into a process. Our data services, we are expanding the scope to include automation in some sense, right? So that we are able to embed the decision making into the processes that we support. So I believe that these two plans will also very important going forward, right, in terms of providing the non-linearity and a platform wherein we can inject more people at entry level, campus hiring, and then train them through that, right, so that we are able to sustain that kind of a momentum.
So what are these value propositions you are talking about? And you also talked about complexity pricing. That's interesting. So if you combine these two, you have a platform in place to execute. The challenge is to hire, train, and get right kind of people and create your own analytics university and get people, hire and train them and then execute and do more managed services contracts on subscription management to various other things. Can you give me some idea about what value propositions these are?
Yeah, so I'll elaborate on the subscription analytics value proposition itself. This is one that we have been working in over the last several years. We have been working with some of the well-known marquee clients in the Bay Area, Silicon Valley, who have transitioned from selling their products and services in a license model to a complete as-a-service model. So one of the clients that we support, right, Adobe, we have mentioned them in our RFP as well. We have been at the heart of their transition from a license model to an as-a-service model. Today, when you go and buy any of Adobe's products, Photoshop or Illustrator, anything, you buy it as a service. Right? And when you are in an as-a-service model, you are connecting with the clients every day, with every interaction. Every time they use the software, you know what exactly which feature you are using, right? What are they trying? What are they working on? So this provides an opportunity to collect and utilize a very large amount of data and information that is not available. So our subscription analytics value proposition is around how can we help companies make the transition from a product license model to an as-a-service model. So we have put together a full suite of framework, methodology, approach, KPIs, benchmarks, right? Everything that will enable an organization to dramatically improve their customer acquisition, retention, right? And how can they put their best product features and innovations in front of them. So that's what that value proposition. So when I say a value proposition, it's a very packaged offering that includes all of these elements. And that is a very important component of how
model
we scale the business.
Now, someone like Adobe is a great example to work with. But will you find many other clients for making big changes, from on-premise to a cloud SaaS model, what Adobe has exhibited?
It's happening already, Pranay. So if you look at even very hard products, it happens. I mean, you would have heard about how Rolls-Royce were offering their jet engines as a service.
Correct.
We are talking to international tire companies that they want to offer the tire as a service. Right? So everybody is thinking about the as-a-service model, not because of the continued revenue generation potential. That is there, of course. But I think the more interesting idea for many of them is that you are continuously engaged with your consumer. Engaged with them through digital channels, through IoT, sensors. so that you can collect a lot more data and information about them. And that is really exciting for organizations. So
and expanding your market also.
Exactly, yeah. That's the game.
Correct. So but the scaling will happen means that you have to grow by hiring more people and do a lot more inorganic way of doing it. How you propose to do? So if you have to be to 5,000 next few years, how will that happen?
Yeah, the scaling will, as I said, the talent will be an important component, but because of our plank of value propositions and because of the automation that we are already driving, we are also expecting that a significant amount of the scaling can happen through the package value proposition. When you have a package value proposition, the effort involved from a sales and business development standpoint, as well as delivery, it goes down because we are able to bring that entire package to the table. Now, we have something to start. There's something that we can directly implement, so the effort reduction will be there. So it should add to the margin profile. That's the expectation.
Very, very interesting. All the very best to you.
Thank you.
Thank you.
Thank you. Our next question is from Karan Uppal from Phillip Capital. Please go ahead.
A lot for giving me the opportunity. So two questions from my side. So first is, in your PPT, you have mentioned that the pure play analytics firms are expected to grow by around 25% for next 4 years. So are you targeting to benchmark yourself with that growth rate, or maybe even higher than that? That's first question. Second is on margins. So with high attrition and also input cost pressures, do you think that you will be able to hold on to 30% EBITDA margins, or you think you can, levers like offshore can help you maintain that?
Yeah, let me take this and Raj add in if required. So from a growth perspective, I think the opportunity is plentiful. This is what I've been reiterating even earlier. The market is very large, and I think the opportunity is plentiful. There is enough runway and headroom for growth. So our endeavor would be to try and grow at a fairly rapid pace as well. But having said that, we are very focused on profitable growth, and therefore we will want to be at the premium complex end of the spectrum. I already talked about how much of the work we do is around solving fuzzy, ill-defined problems. We will want to focus in that space, and that space itself is growing. In fact, one of the things that we are witnessing is that more and more of client engagements are actually maturing, in terms of the complexity of what they want to go after, because a lot of the low-hanging fruit, has been taken in some sense. So therefore, we are expecting that the whole data analytics space itself will mature, with increasing availability of data, and we are confident that there will be enough to play there, from a growth perspective. But we wouldn't want to chase on-site only staff augmentation opportunities, or we wouldn't want to chase simple lift and shift and migration type of opportunities, where the margins are lower. We want to position ourselves as a premium player, and we'll continue to do that. From a margin standpoint, obviously, what I just said has a bearing on that. But instead of giving a particular guidance, I would say that the intent is to focus on profitable growth. We see enough headroom. We believe that the investments that we are making will pay us well, in terms of building the necessary capabilities, assets, and solutions, wherein we can get the non-linearity that I talked about. So it's not just about what work we go after, but also our ability to generate some non-linearity in the way we deliver that work. So all of that should play into the entire profitable growth objectives that we have.
The one other point that I would like to add to what Rajan already stated is, again, if you earlier in the call, we addressed this whole question on our revenue per employee being significantly higher compared to some of the peers that you may track. And that is actually testimony to the fact that we also solve fairly complex business problems. And therefore, we would like to believe that we have, in terms of the pricing power, we are better positioned than some of the other peers in the market to be able to negotiate better pricing from our customers on an ongoing basis. Even in the current quarter, which is the recent bygone quarter, there were increments that were given to close to about 80% of our entire workforce, ranging anywhere between 12 to 16%. Despite that fact, you would have noted that for Q3, our margins were close to about 30%. So we were able to weather the impact of even the wage hikes that had to be given out in this particular quarter. So that's the point that I'd like to make.
Okay. So, sir, one follow-up on this is that you're saying that you are in a better position in terms of pricing than the other players. So, is your pricing higher than some of the maybe system integrators or other analytics firms, or how is it?
So the pricing will definitely be different in comparison to regular IT services work. As Raj pointed out earlier when he was talking about the pricing model, the pricing is typically dependent on the complexity of the engagement that we go after, the skill mix that we need to bring in order to address that complexity, and more importantly, the outcome that we are able to deliver, right, because of that. Now, if it is customer churn reduction, for example, how many basis points or percentage points are we able to impact? So these all go into determining the pricing. And the point I made earlier is that customers are going after tougher, more mature problems. So therefore, that's what gives us the confidence that the unique blend of skills and focus that we bring will continue to give us, right, the pricing power because of the problems, the nature of the problems, and the impact that we are delivering.
Right, sir. So last question, one bookkeeping question, which is, sir, if you can help us with your attrition rate and your hiring target for FY22. Thanks a lot and all the best for next year.
Sure. Yeah. So the attrition rate, as with most organizations, we have seen an uptick as well. The whole of last year, I mean, FY21, it was in the 20 to 22% kind of range. It has definitely jumped up in Q1 and Q2, touching as high as 30% or slightly above that in some instances. But we have started seeing a dip in the attrition in Q3. Also because of the wage hikes that I talked about and the ESOP plan that, the employee stock option plan that we have rolled out. More importantly, we are also implementing a more robust career planning framework and an internal job rotation program. A lot of the people that we hire, in fact, a big chunk are all youngsters asking for variety and challenge, right, in the work that they do. And we see that the career framework and the internal job rotation programs are addressing their most important concerns in terms of learning new skills, having a challenge in their jobs and variety. So all of those things are helping address the attrition. So attrition has been trending downwards through Q3, and then we see that trending downwards in Q4 as well. Of course, the market is pretty hot. One of the things that we're doing is focusing more of our hiring right now on the campus joiners. So recently, we had kicked off our campus hiring for people who will join us in the May-June timeframe, and we have made more than 250 offers already at engineering campuses as well as postgraduate campuses, business degrees as well as data science and analytics kind of degrees. I cannot give a specific number in terms of how many people we will hire in the next quarter or in the next year, but it will be sufficient to address the growth and to factor in any kind of attrition that we witness, right, at the lateral or at other levels. So right now, it's a fairly robust campus hiring program that we are executing. We have the mechanism in place to bring these people in, induct them quickly, and make them productive, right, in a short span of time. So at this point in time, there is a good amount of confidence that we have the people needed to deliver on the growth that lies ahead of us.
Yeah, the one other point that I'd like to add on attrition itself is, given our size, even the current year, of course, we've added employees. We've had a net addition of about 243 employees in the current year. But if you look at our overall size, we are still a fairly small company in terms of headcount. We are a little shy of 900 odd people. And therefore, tracking attrition as a metric on a quarter-on-quarter basis may sometimes be misleading, which is why we would also, as we go along, we would like to sort of look at this metric more at an annual level as opposed to tracking it and reporting these numbers on a quarter-on-quarter basis. So that's the one thing that I would like to state.
Thank you. Next question is from Ritesh Rathod from Nippon India. Please go ahead.
Yeah, thanks for giving me the opportunity. would there be, like, have you had more people on your bench or or in your hand? You would have delivered higher growth rate? Like, was there any revenue fulfillment issue because of the supply side?
No, absolutely not. I mean, at any point in time, we are maintaining at least 15 to 20% of buffer capacity within the organization. Partly, the reason for that is because of the philosophy that our people need breathing time, given the nature of the problems that they solve. So there is enough self-learning, research, market awareness, contextual understanding. All of this is called for, and collaboration time as well. So we do not drive for 97% utilization as you might otherwise see, right, in the ID services space. We believe that an utilization of 85% or thereabouts is appropriate for the nature of the work that we do. So typically we have the buffer capacity needed to take up new engagements. There might be sometimes one or two roles that call for a very specific skill set, which is esoteric and we do not have, which we might have missed out in small numbers. But even these, we are able to either upskill or cross-skill our current people or find people lateral, right, to come in and take up that opportunity. So I would say that the revenue leakage or loss on account of not having people with the required skill set is almost zero. I mean, it's non-existent. And at this point in time, we are operating with a healthy buffer, which allows us to ramp up on any engagement fairly quickly.
What's the current utilization number?
So we measure utilization in a slightly different way. I mean, we looked at our build people and then how they are utilized, and then we also looked at the buffer percentage. As I said, the overall will be at the 85, between 80 to 85% mark, and that's what therefore translates as the unutilized capacity that's available.
My second question is, if I see your annualized revenue from top 5 clients and the concentration which you have provided in the client bucket metrics, on an average you bill them $5 to $7 million kind of a range. If I'm assuming I'm correct, can you first help me understand how tough is this journey to reach to a client to $5 to $7 million revenue range? And when you see yourself in next 3 years reaching $150 million, would these clients also triple from $5-7 million to $15-20 million range, or you need to add many more clients to do that? Because if you see your narrative solving fuzzy problems, that it itself could be ironical. That moment you solve the problem and client is satisfied with it, the billing from that project could drop dramatically, even though there could be some maintenance work. But post that, you need to go and find another project or another problem in the same client, which could be time consuming, and which it's sort of a replenishment kind of a thing. So can you help me understand this complexity, like on the client side, client mining side? I presume you have helped a bit in the past questions which people have asked, but if some addition will be helpful.
No, absolutely. No, thanks for the question, Ritesh, because it helps illustrate the model a little better. If you take the top 10, 15 accounts, the revenue coming from a single client would be, the average revenue would be quite high, right, as you pointed out. May not be in the $5 million range, might be slightly lower, but it is definitely north of $1 million or $2 million. The interesting thing is that the point that you made, right, that once you solve a fuzzy, complex problem, then it is done and dusted and then you move on. Our experience has been entirely the opposite of that. These large organizations, there is no dearth of difficult challenges and problems that need to be solved. In some sense, the deeper you dive into the data and you understand the business context, the more opportunities emerge for integration, cross-pollination, collaboration, a more holistic approach to the data set that they have and how they can use it across their business. You'll be surprised that most large organizations that we work with, they suffer from the same challenges in terms of silo mindsets, data availability, some amount of ownership of data and data legacy challenges. So all of these things introduce different kinds of hurdles and barriers that need to be overcome. So data analytics is seen as a way by which you can cut through some of these things, and we keep increasingly uncovering more and more opportunities. Just to illustrate the point, our first account in the United States, we went from about $0 to $6 million in terms of revenue over a 10-year time frame. The largest account that we have today, we have gone from about $0 to $10 million in a 4-year time span. Right, we started off at 0, and then we are about $10 million, right, in a 4-year time span. We see that happening in many accounts as well, right, in terms of what we uncover as we undertake the work. We typically use the monthly and the quarterly business reviews that we have to showcase to them what is the art of the possible, what more they can do, right, with the data that is available to them, what are the appropriate business cases, use cases that they should be pursuing. As I said earlier, because of this, the heart of the problem, I said, no, it's understanding behavior. That's a very, very complex thing, and no amount of modeling can actually make it as good as how the person exactly behaves, right? So human behavior, process behavior, these are very complex topics, and that is what we see in many of our engagements. So to address we have, right, when we get to 100 million, 150 million, we definitely expect that many of our existing accounts will grow. That's for the mining farming initiatives that we have today. We believe that a lot of that growth will come from that. But having said that, we will also add to the client base. I mentioned earlier in my preamble that there are many dimensions that we are exploring, right, to add to the client base. There is a geographic dimension of Europe and Asia Pacific that I talked about. There is the penetration in the industry segments, BFSI and retail that I talked about. I mean, these are huge leaders on data analytics, and we are hardly working with a handful of clients, right, in these areas. There is also the horizontal initiatives like data engineering, the advanced analytics work, the supply chain work. We believe that these are very relevant. So we will definitely continue to add to the client base as well. But with every passing year, the intent would be to try and mine more in terms of the accounts that we can work with.
And maybe a counter to this point you said in terms of shortest time you ramp up your client within a 4 years from 0 to 10 or 0 to $6 million. Does your key employees or the employees who are working on those projects or solving those problems becomes very easy target to get poached either by the client in-house IT team or the large vendors who are working in the same client? And have you seen those kind of problems?
In general, with the clients, that hasn't been much of an issue, except in 1 or 2 instances. The one instance where it happened to the client decided to insource all of analytics, and then they approached us, and after a little bit of heartburn and discussions, we said that let's support you because we are more interested in the relationship, and we had been working with them for a long period of time, and they were instrumental in our early years, right, in terms of ramping up. So we did end up giving a bunch of our people, right, for them to kickstart their internal initiative. But barring 1 or 2 instances like that, in general, we have contractual understanding and arrangements with our client that they do not poach our people, and we don't lose too many people directly to current client organizations. Having said that, when we lose people, we typically see that people join other client organizations, the ones that we may not be working with, and I'm lumping them all under the client organization, meaning that we may not be working with client XYZ, but they might find an opportunity there, right, and then they join them. Very few losses to back office analytics capabilities in India. This is typically on-site client opportunities available. We do lose people to product organizations, right, and startups. That is the biggest challenge right now because many of them are funded well, and they are ready to attract people, right, by using fairly disproportionate compensation structures. So we have lost people in those instances. In general, our philosophy and approach has been that even if we end up losing people in the short term to some such organizations, in the longer term, it is beneficial because they continue to be ambassador of the organization. Some of them have turned clients of ours at a later point in time. Whenever we organize alumni events, either here in India or in the US, we find a huge turnout and everybody is a well-wisher. So we are not particularly worried about people joining client organizations or even other product companies at this time.
Thank you. Next question is from Akshay Ramani. Sorry, Lamnani from Axis Capital. Please go ahead.
Hi, thanks for the opportunity. I just wanted to ask, you mentioned about non-linearity in the business. I just wanted to understand which pricing models will lead to this non-linearity. Are you talking about the outcome-based pricing, or would this be led by SaaSification of your IPs or something else? Just wanted to understand that.
Yeah, driven more by, as I said earlier, the value propositions that we're able to build, which contain a full suite approach, methodology, thought leadership, knowledge capital, even libraries of utilities that we might have created, right, to execute such work. So, for example, campaign analytics and operations. We have created a library of utilities that are applicable and relevant for any kind of marketing campaign scenario. So these are things that we can very easily bring to the table, and that helps cut down the amount of effort required to deliver the work. Also, the SaaSification and automation, right, that you mentioned, that will also be an important component in terms of the non-linearity. More so in the data science, in the data and DevOps kind of scenario, and in data engineering, right? And these are all areas where we believe that there will be opportunities for further streamlining how we do the work and how we execute the work. Consulting is the main plank, though, for all of this, because we believe that a good consulting diagnostic exercise working with the client sets up the right kind of initiatives, the outcomes that they can shoot for, and helps establish the business case, right, for how you can approach such work. And that is where the pricing discussion also typically happens. So how we size and how we staff the engagement and which assets and tools and accelerators we bring to the table. Those are all influenced by our ability to do a good consulting diagnostic exercise upfront. So we will continue to leverage that kind of an approach going forward as well.
Right. And do you engage in outcome-based pricing models for a business?
Not yet, though we can consider. The challenge with many of the situations in which we work is typically attribution, right? I mean, if you talk about reducing customer churn, right, as an initiative, for example, the data analytics and the deliverables, the hypothesis testing and the validation will be one part of the story, right, in terms of what the data tells and what you need to do and so on. But in many of these instances, there are numerous other factors that need to be taken into account by the client organization in terms of their prioritization, other initiatives that are running in parallel, the amount of bandwidth and effort that they are able to commit, their risk profile, right, in undertaking something new that even though the data tells us, right, are they ready to experiment in full steam ahead and all that. So all of these will mean that it is a fairly challenging attribution problem when it comes to establishing the outcome itself. So right now, much of our engagement and model is in proving the model and helping clients understand that if you undertake these things, right, you can get that outcome. But in most instances, we still leave the decision on implementation to the full extent to the client. So therefore, it's not a direct outcome-based pricing. Maybe in certain pockets and niches, for example, inventory reduction, right? If we just look at that, or shelf space optimization, right, in the retail context, these are things that we can take up. Going dark analysis with respect to marketing campaigns, right? That's an area where we can actually do an outcome-based pricing. So we will be exploring these going forward. It's also about client appetite, right, and the willingness to adopt such a model.
Thank you. Our next question is from Hemant from ZF Capital. Please go ahead. Hemant, your line is unmuted. Please unmute your line and proceed with the question.
Yeah, hi. My name is Hemant. My question for you is related to the revenue per employee that you're charging today. I know many commentators have mentioned in the earlier part of the call that your revenue per employee is on the higher end, right? And from my calculations, it shows that you have about a $60 to $65 blended billing rate for your employees. But my question is, many of the dynamics that you mentioned around increasing salaries. You increase salaries twice a year. You provided more ESOPs to about 30% of your employees. Leads me to indicate that to maintain a good profitability, you will have to continue increasing your employee, right? So compared to the traditional IT firms, while your revenue per employee is higher today, in fact, to maintain your profitability, you have to continue increasing your revenue per employee over the coming years. And so my fundamental question is, what are some measures you will take to be able to do that? And the dilemma I see is that when it looks to the type of work, you're moving to more managed services work, which tends to be generally a lower revenue per employee work. So how do you solve that dilemma?
Yeah, I mean, I'll address the second part of the question first. I mean, the managed services is an engagement model that provides us the flexibility and the fungibility that I talked about earlier. The nature of the work that we do continues to remain fairly complex and fuzzy, right? We are not moving down the value chain to do work, the regular dashboard lift and shift, for example, right? We don't pursue those kind of opportunity. Every piece of work that we take on is a fairly tough problem that they want to go after. The managed services model is more a construct that allows the client as well as our organization, right, to really use the flexibility in terms of who we bring on, what time we are able to deploy some expert resources, how we are able to ramp up people who might be coming in and coming in fresh from campus, for example, right, as a part of the component. So all of those things play out right from a managed services construct. I haven't seen any reduction in the complexity of the work itself. In fact, if anything, most of the work that we might have considered complex, say 4 years back or 5 years back, they've all become simpler problems, right, which are either done through the automation or some of the libraries and utilities that we have built already. So in general, the direction is towards more complexity. So that is happening. Now, having said that, coming back to your revenue per employee, we obviously, I mean, the more complex the challenges and the more impact that we can create, we expect that clients will also understand, and therefore they will be willing to pay the premium that is required for going after those problems. That is what we have witnessed even in the last 18 months or 24 months. We have seen that our pricing, premium pricing, has continued to move in the right direction. More so at this time, even clients are seeing the effect of inflation, demand supply gaps, and they are very understanding when we say that, you know what, this skill set or this combination of skills that you need to pursue this initiative is something that is challenging, and we need to hire the right people, or we need to have the right people on the engagement, and we need to therefore charge you at a certain rate. So that is happening. The other thing that will play out here is the non-linearity that I talked about. I mean, more packaging in terms of the specific value propositions, building the necessary libraries and utilities and assets and accelerators, and then being able to bring all of them to the table to really drive effort reduction. That will be an important aspect as well. The general forces of commoditization and automation will play out, and our endeavor would be to stay ahead of the curve, right, in terms of the work that we take on. And if it is getting commoditized or automated, that we are also in the action, and we are able to address the automation using our own libraries and tools and assets that we can bring to the table.
Hemant, we'll be taking the last question for the day.
Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Hey, thank you. So overall, I just want to reiterate a couple of things. One is that we are very pleased with how the quarter has been for us, not just in terms of the revenue and the numbers, right, that we have talked about, but also the fact that we have been able to kickstart a lot of the initiatives that will set us up well for coming quarters. As I mentioned before, we see this truly as an inflection point. In general, there is an acceleration of all things digital transformation, and there is an uptick in the volume of conversations and clients' propensity to pursue more mature, complex initiatives that can leverage the power of data analytics. I also see that data analytics more mainstream in the sense that earlier it used to be fringe initiatives that were run by a particular business unit or a functional head with the limited data that was available within their own silo. We see that increasingly initiatives are more cross-organization. They are moving out of the silo mentality, which means that central teams and organizations, like the CIO, CTO organizations, will start getting involved. And therefore, the initiatives will become bigger and they will become more meaningful and impactful. So we are excited by the prospects of that as well. I mean, we have been several of the data engineering initiatives that we have kickstarted and that we have won. We are building relationships with the new ecosystem that is emerging. And we believe that we have the right kind of capabilities. In general, we have focused on the more complex ends of the problem using new technologies, the latest that is happening. For example, in data engineering, I talked about the Snowflake partnership. We really work with the cutting edge stuff that is available there, whether it is Snowflake or Databricks or Redshift or Synapse, for example. Right? These are the areas that we are focusing on. And at this point in time, we feel very confident that we are on a good wicket and we are putting in place the initiatives and measures that will play out in the right way in the coming quarters. So overall, confident about how this quarter has been and the fact that we are setting things up well for the continuing quarters. Of course, we will want to make sure that now we are executing well on these as well to realize the opportunity that lays ahead of us. Yeah, so that's really what I wanted to share. Thank you.
And I'd also like to add that it was lovely interacting with all of you. This is our first earnings call post listing. In case there are any of you who have questions that are yet to be asked, please feel free to reach out to our IR team, and they can share it with us, and we'd be happy to answer them.
Thank you very much. Ladies and gentlemen, on behalf of Latent View Analytics Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.